We've all heard of a company going public, right? That's an IPO, your chance to be an early investor. But the real action begins in the secondary market, where participants trade based on differing opinions about a stock's price. For example, Trader A believes the stock price will decline and decides to sell, while Trader B thinks it has overreacted and opts to buy. At a common price, A places a sell order and B places a buy order through their brokers. The brokers transmit these orders to the stock exchange, which matches them and executes the trade. Their benchmark indices serve as barometers of market performance. The NSE's index is called the Nifty 50, which represents 50 companies listed on the exchange. The fluctuations in stock prices occur due to various factors, including news or events related to the company, the industry, or the economy as a whole. This lively cycle of buying and selling reflects the demand and supply that drive transactions in the market as securities constantly change hands. The secondary market is broadly classified into two types: exchange-traded markets and over-the-counter markets. Exchange-traded market is a centralized regulated marketplace. Here, since securities are traded on a regulated exchange, it offers transparency, investor protection, best market prices, no counterparty risk, grievance redressal mechanisms, and protection up to a prescribed limit from the Investor Protection Fund. Did you know only listed stocks are traded in these markets? In contrast, the over-the-counter market is decentralized, where securities are traded directly between parties with no investor protection or regulation. There is also dabba trading, which refers to illegal off-market trading, where transactions are done outside the exchange, often to avoid taxes or regulatory oversight. It can lead to legal consequences, financial losses, and market manipulation. After understanding the types of markets, let's learn about few main types of orders placed. Market order, an order executed immediately at the current market price. Limit order, an order that specifies the maximum price the investor is willing to pay when buying or the minimum price they are willing to accept when selling. Stop order, an order that becomes active only when a specified trigger price is reached, prompting a buy or sell action. Now, let's look at order matching on a stock exchange. This is how the order book looks like. All buy orders placed are set from the highest price to the lowest price because the seller would obviously like to sell at the highest possible buy price that is offered, and the reverse is true for the sell orders. The best buy order is the one with the highest price, and the best sell order is the one with the lowest price. The best buy order is matched with the best sell order. If the orders are put in for the same price, then orders that come in earlier gets priority. Once an order is completed and trade is executed, ownership of the share is transferred to the investor. Post-payment, the shares are added to investor's account. Regulators ensure that this entire process remains fair and transparent. The secondary market aims to offer investment opportunities to all types of investors across various options, provide liquidity, allowing investors to easily buy or sell their securities whenever they wish, help determine the fair price of securities based on supply and demand. Operating within a well-structured environment, the secondary market involves various participants, including investors, brokers, dealers, market makers, and regulators who facilitate efficient and fair transactions.
समझकर Demystified.